Welcome, everybody. I'm Jeff Finn, CEO at RealNex, and delighted to have you with us once again for our market update with Dr. Jeffrey Fisher. This one is a particularly important one given what's going on in the world and in the market. For quarter after quarter, all we did was report about record pricing and record low cap rates, and we're in a new world now where things have been impacted dramatically, and we're getting results in now, data first in on the first quarter since COVID began, and Jeff will present his findings and analysis. We'll have a few polls to share. In the meantime, hope you're all doing well and getting back to it and making the most of the market, and hopefully this the insights we'll be able to share today will help you work with your clients and operate your business more effectively with this updated data set that Jeff will be presenting. Also wanted to let you know that next week we have another session. We have a virtual reality session. We're finding more and more, even before COVID, the need for virtual reality, virtual tours was becoming more mission critical and important and beneficial to the industry, and we're now finding it to be absolutely demanded by clients that want to see space, need to tour space, but can't get to the space, and often the space doesn't quite exist yet. So a camera tour, video tour, it doesn't work. So virtual tours are the best alternative to model space in a future state, what it could be, what it is, and what it could be, and be able to envision it, build it out, and tour it as you'd like. So join us next week. Go to the webinar page at realnex.com and sign up. And again, another great session, and love to share with you some of the things that we're doing and we're seeing in the leading edge of virtual reality. So, Jeff, I'm ready to turn it over to you, and we will get started. So,
okay, thanks, Jeff.
We will share the dashboard here.
All right. There we go. Show my screen.
You're up and running.
Okay. Just need to switch displays here. All right. Oh, thanks for joining us for our quarterly commercial real estate market update. As Jeff said, not a lot of evidence on how COVID-19 has been impacting commercial real estate. Lots of webinars and reports, people speculating as to, how it might affect it going forward, and some evidence on rent collections. Not a lot on values, but we do have some evidence from, in this case, the National Council of Real Estate Investment Fiduciaries, as the acronym NCREIF, and that's based on $650 billion of office, retail, industrial, apartment, and hotel properties throughout the U.S. The data comes from all the large institutional investors, so kind of interpret a lot of my slides based on what we're seeing from the institutional investors that manage large funds for plan sponsors and high net worth investors. But the trends are really, I think, indicative of what's happening in the overall commercial real estate market. The advantage of this data is it's collected every quarter. It includes details of the income and expenses in all the properties, as well as an appraised value for the properties or a sale price if a property did sell. And so the data allows us to calculate returns every quarter. And as you can see from this chart, we've got the first negative return. The return is basically the change in value plus the cash flow that you got during the quarter. So each quarter we can say, what would you have earned as a rate of return if you bought at the beginning of the quarter and sold at the end of the quarter? So you can see it turned negative, not real negative. It was like minus 1%. But that is the first negative that we had since going back to, as you can see, the financial crisis, which carried us through the 2009 period, had recovery starting in 2010. If we look at that on and I might just emphasize that these are quarterly returns. So you could roughly multiply by 4 if you wanted to see what it would be on an annualized basis. So it'd be like around minus 4% this quarter, and that's also an unlevered rate of return. So if we look at those properties that did have leverage, although it's a relatively conservative loan to value ratio for the institutional investors, around 44%, but that return obviously is a little bit more negative. As you know, leverage can work for you or against you. And if you are earning less on the property than you're paying in interest, you're going to have negative leverage, and certainly with a negative total return before you even borrow any money, that's going to drive your leverage return even lower. What we witnessed this quarter was some cases where the value of the property that was reported to NCREIF was exactly equal to the loan balance. You know what's going on there is it's non-recourse debt, and they said, well, you know, I can't lose any more than the loan balance. I can give it back to the lender. So on my books, I'm just saying the equity is zero. It doesn't go negative. But we are starting to see some properties, even those owned by the institutional investors with somewhat conservative leverage. We're starting to see some properties that are going to probably end up going back to the lender. A question that's been coming up because we just haven't had a lot of transactions, and so appraisers are having a hard time knowing, you know, where value should be. In fact, one of the managers that had reported a value equal to the loan balance, we said, well, you know, we'd really like to know what the property is worth. If it did sell free and clear of the loan today, it didn't have a loan on it, because, you know, our index is based on what the property value would be if it was unencumbered by financing. And they said, well, we have no idea. We just know it's worth less than the loan balance. And some people are arguing, and I've seen some articles written saying, well, look at what's happening with REITs. That's telling us what's happening to private real estate. It's just we don't have the transactions in the private market, but we do have transactions every day of publicly traded REITs. So why not look at REIT prices? Well, you know, my personal opinion is REITs are impacted by a lot of other things that aren't necessarily impacting the underlying real estate. In the long run, I think REITs are going to reflect the underlying real estate, but in the short run, I think REITs tend to move up and down with the rest of the stock market. The values depend more on, you know, how investors in the public market, which can be different than the private market, you know, perceive the REIT manager's ability to buy and sell at the right time and manage through this crisis. So I think we got to be a little careful saying, well, look, REIT prices were down 30%, but if you look at this chart, look, NAREIT was way down last quarter. I should say the quarter before the last quarter, you know, so does that mean that private real estate values also had returns really of minus 25% and not just minus 1%? But then look, this quarter reached back up, you know, so had 5% this quarter. They're not back up to quite where they were before, but when you look at the stock market, you know, new highs almost every day, backed off a little bit. Haven't seen the close today, but so I think we got to be really careful saying, well, let's just look to the public markets, and that's going to tell us what's happening in private real estate. Maybe the truth is somewhere between what we can get from the appraisal-based data versus what you see in the public market. But I certainly would cautious people on just looking at what happened to REIT values and saying that's what happened to the real estate market if we really had good price information. So that's my spiel on that. NCREIF actually has an index for those funds that try to put a value, they have to put a value on their properties every day for the defined contribution plans. And it's published actually on a 30-day moving average basis. So you don't really maybe see the full drop that you would have if you could actually see each day as opposed to an average over the last 30 days. But you can certainly see how COVID-19, you know, really just like it did with stocks and REITs had a drop in return. Here it shows up like around April 1st, but then has come back up in terms of the rate of return anyway. In fact, it recovered to a little bit higher level of return and then kind of leveled off, still slightly positive on a 30-day moving average basis. So we also saw news last quarter about the GDP. GDP plunges a record 32.9% annualized for the second quarter of 2020. That's a little scary. And, the question again would be, does that foreshadow what happens to real estate values and returns? So let's look at that relationship historically. So going back to the beginning of the NCREIF property index, the NPI is the NCREIF property index compared to the GNP. Yeah, there's a correlation there. Although when we got into the recession in the early 90s, kind of interesting that the GNP actually maybe one quarter it dropped negative, but then it was back up again. Whereas some of you may recall that was a recession where it just kind of took a long time, it seemed, for real estate values to recover. During the more recent financial crisis, when the GNP turned negative, yeah, returns dropped quite a bit, but they also came back very quickly, had more of a V-shaped recovery. So we come out to the current quarter, yeah, GNP, on just the quarterly basis, around 10%. We haven't had values drop, certainly near that much, but I don't know that this recession will mirror past recessions in terms of a lot of these relationships, whether it's with REITs or whether it's with the GNP. As Jeff and I were talking about right before we got on here, the causes of the current recession really more self-made in a sense. The government, saying, well, let's shut down the economy and try to slow down the virus, but it can be turned on, especially if we have a vaccine that people are confident is going to work. Things could turn back around very quickly. We can turn it back on ourselves in a sense, as opposed to there's a lack of liquidity and just capital is not there, and the banks don't have the money, or the overbuilding that we had. And you can't do a whole lot about overbuilding unless you start tearing down a bunch of buildings. But Jeff, I don't know if you have any thoughts, but I think this recession, the cause is quite different, and the recovery could be quite different, and the relationship with the GNP and REITs could be quite different.
Yeah, it certainly seems that way. And from people that I've talked to and the market, at least anecdotally, there's just so much money on the sideline today versus what was in place in 2008 when we had a credit crunch and no capital really to deploy that led to the plunge. This is something that there's money there, and as soon as there seems to be a rebound in economic activity, hopefully we'll get price discovery and movement where that capital will be deployed. Right now, there's a wait and see, which is the challenging part, where there's a gap between the bid and the ask, and there's still people waiting for the shoe to drop, and the pressure from banks and to take hold and force the hand.
Right. So our first polling question is, it's always interesting to see the response that we get to these questions. What will the annual unleveraged total return be for institutional grade real estate? In other words, the kind of returns that I'm showing you for the institutional investors. Be for real estate for 2020. Remember, we're about -1% for the current quarter. It was still slightly positive last quarter. We've got 2 more quarters to go. Some people think that we haven't really seen the price drops yet that we should see in commercial real estate. So is it going to be below -3, or -3 to -2, -2 to -1, -1 to 0, or anybody out there that's optimistic enough to say it's going to end up above 0 by the time we get to the end of the year? And let me open up the poll. I think I can also see it.
Yeah, we've got it going. Give everyone a few more seconds, and we will close. We get people well trained now. They jumped right in, and we're getting the votes cast quickly. So no mail-in ballots this time, Jeff, but we'll take them all.
But we do have some optimists out there.
Yeah, we've
got 14% that think we're going to have a pretty quick recovery, and it's going to be above 0. We've got another 14% that say it's going to be just -1 to 0, so sort of where we are now. It's going to level off. We've got 29% though that think it's going to be -2 to -1, 19% -3 to -2, and 24% really diverse opinion. 24% below that -3. So we've got some glasses half empty and some glasses half full. Interesting.
I think it may also depend on the market that you're in. What we've seen is, there's a great disparity in product type and market. If you're in New York in office leasing, or if you're in a major logistics or distribution hub, you're seeing different things. If you're in multifamily versus you're working in retail, or hospitality, it's all different worlds. A lot of different aspects of this one.
Right, and the question was intended to be if you lump all that stuff together, but I'm sure people were looking at it kind of from their perspective, and they're influenced by the market they're in and the property sector that they're in. So let's look at interest rates. Interest rates, wow, hard to believe that we were back at 14% in 1982, and now we're down to practically zero. What we got, like 0.5% or something like that right now for 10-year treasuries. I remember, Jeff, back in the early 80s, where people were saying that interest rates would never go below 10% again.
That seemed to be a threshold, and all you did was refi. You get, every couple of years you were able to refi and benefit all the way down through this cycle, thinking that you caught the bottom, but it just kept going.
And so looking at the interest rates is I think important for us to think about what kind of discount rates investors want and returns they want for commercial real estate, because there'd be a risk premium on top of that, and it also impacts cap rates. This is a forecast. I should have put the source on here, from Real Estate Research Corporation, RERC. Ken Riggs, who's the president of RERC, joined me on a similar webinar for NCREIF last week, and so they have a forecast, and you can see there's a pretty wide range in what the forecast is for 10-year treasuries. So it could be anywhere to hovering around zero as a worst case scenario. I guess not having the negative rates we have in some other countries, but boy, the difference between 0 and 2, if cap rates could differ by that much, that'd be a huge difference in the valuation of the property, to have a 2% difference in what cap rates might be, 200 basis points difference. So RERC looked at the spread over the 10-year treasuries for the pre-tax yield and for the going in cap rate. So this is a different sample than the NCREIF properties. The NCREIF properties is all the institutional properties from the members, but in this case, Real Estate Research Corporation is looking at a much broader set of properties coming down much lower in value. So these cap rates and these required rates of return would be higher than it would be just for institutional properties. I think it was about 100 basis points higher. I have to go back and look at the other chart, but you can see there is a forecast for an increase in the going in cap rate, which would be the cap rate used to value the properties based on the expected first year net operating income compared to the value of the property. And then the rate of return spread also might increase a little bit over what's happening with treasuries. And I think that would be because some additional risk in the market. And then this is turning to the NCREIF cap rates compared to the same 10-year treasuries over time. So here you can see that the spread is really wide right now. And that's one of the reasons why maybe we won't necessarily have much of an increase in cap rates, even if interest rates start to go back up. And it's hard to know which of those forecasts that we saw earlier, is going to come true. You'd think with all the money the government is spending right now and the debt going up, that rates would have to go up at some point. But in this case, because we have a pretty wide spread between the cap rates and treasuries, we do have some cushion there that could protect us against rate increases. I just hear a lot of different opinions right now about what might happen with cap rates. And of course, cap rates are the way we think about what's going to happen to real estate values. And, some think they could go up, something think they could stay the same, something they might fall. It's really tough right now to say. This focuses in on that spread that I just talked about between the cap rates and the 10-year treasuries. And you can see it's pretty much near, at least over this time period, the highest it's been. So again, kind of a cushion that we have between cap rates and interest rates. This is kind of a reminder because we're always trying to figure out where returns are going to go, and so this is sort of a textbook reminder of where the return comes from, based on roughly on kind of the numbers this quarter, rounded just to kind of give you an example of how to think about this. So with cap rates, which is kind of like the yield that you get going into the quarter or into the year, around 4%, but we had NOI growth that was negative. We'll see that more in some charts here in a minute. So we had, at least on a temporary basis, hopefully that'll go up starting a year or more from now, but we had some pretty significant drops in rents this quarter. And so with negative NOI growth, that's going to pull down your rate of return. The capital expenditures are going to come out of the income return that you're going to get, because you have the cap rate doesn't include capital expenditures. So the cash flow that you're getting is going to be a little bit lower by the amount of CapEx that has to go into properties. And then a cap rate change is whether cap rates are going up or going down. Cap rates going down, which they have been for quite a few years now, really has helped rates of return. But as cap rates go up, if they do go up, that's going to hurt us. And in this case, you can see that cap rates actually helped us this last quarter. This is based on the appraisal assumptions that are going into the valuation of the properties. In this case, the data comes from Altus, another appraisal management firm. I mentioned Real Estate Research Corporation a minute ago, RERC. They do a lot of the appraisal management of properties that are in the NCREIF index. Altus, that acquired Argus, also does appraisal management, and they do the valuation of management on a lot of these funds, and they provided the assumptions that are going into the models, like the Argus models. So and now we're starting to look at things by property type. So you can see how, and then a lot of these charts I think are going to end up being kind of a similar story. Retail, you can see that the discount rates went up. So this is the discount rate. Think of this as the rate of return that investors need to have on projected cash flows going forward. So we had an increase from around 6.5% rate of return that would be used as a required rate of return to investors, up to not quite 7%. So I guess the scale on this makes it look a little bit more than it really is, but I guess not a surprise that with retail, the discount rate went up a little bit with more of a risk premium. This would be purely, I think, a function of risk differences, because when we're talking about a rate of return, we've already factored in expected future growth and what's going to happen to interest rates, and so it's really just how much of a risk premium that you need for that property type. The other ones have stayed pretty steady, actually maybe down a little bit for industrial and for apartment properties. And then if we look at cap rates, it's pretty similar story. Cap rates now, although I take that back, it isn't. I don't think what you might first expect for retail properties. Why in the heck did the cap rates for retail properties fall? Because if you expect to have less growth in the future and more risk and a higher discount rate, how the heck can the cap rate, which is the ratio of your expected income over the next year relative to the value of the property, how the heck could that fall? I think what's going on there, Jeff, is that this past couple quarters has been kind of different in that all of a sudden a lot of people didn't pay their rents.
Actually, the cap rates could be zero in some of these.
Yeah. So the people didn't pay their rent, but that rent is expected to be collected in the future. A lot of those leases are being renegotiated. I've seen some where they said, okay, you know, you didn't pay in April and May, but you know, starting in, you know, whatever, you know, maybe starting January next year, we want you to start paying that back over the next 2 years, and so the values haven't fallen near as much as the income has fallen. So it's kind of an unusual situation. Usually the two are moving together.
The other thing is retail is being bought for conversion for other use, not just to continue as is.
That's a good point. The highest and best use is changing, and in some cases it may be that the next use is considered to be even better. And you do see where like Simon Property Group has worked out deals with Amazon. You know, we're going to have Amazon distribution centers and a lot of the mall spaces. So interesting things going on with retail right now. Here's the market rent growth. So you can see how market rents have dropped off for all the property types, most for retail, next most for office, but also a little bit for apartment and a little bit for industrial properties. And then our survey question, polling question, what will cap rates be for the nation by the end of 2020? Again, kind of think of institutional. So if it's less than institutional, it would, you know, be a little bit higher, but kind of scale your thinking to be more what we'd call the investment grade properties. We're going to be below 4, 4 to 4.5, 4.5 to 5, or above 5.
Interesting balance here, Jeff. I'll let you read them off.
Yeah, so 7% below 4. So actually some further drop in cap rates. 33%. Oh wow, it's tied. I was almost going to say that's the mode, but it's actually a dead tie at 33% for 4 to 4.5 and for 4.5 to 5. But then 20%, or no, 28% that it's going to be above 5%. So do we get to save these numbers, Jeff, so we can kind of see at the end of the year how well we did?
Well, we'll bring them back for sure.
Yeah, let's do that. This is something new that haven't shown in this webinar before. It kind of pops up as something that's interesting to look at whenever we're getting into a recession. I think this was first suggested to me to look at back in the early 90s recession, where the question was, well, how many properties are being written up? Even though we're in a recession, there are some properties that are increasing value, but there's also properties that are decreasing in value. So the blue is write-ups, and then the orange, red, whatever, is the write-downs. So you can see that the number of write-ups dropped to, like, 20% rounded, where the number of write-downs, so about 80%, just all of a sudden, right? Just all within like 2 quarters, and then interesting also to compare that with what the shape looked like. We don't know what the shape is going to end up being this time around, but look at back in the early 90s recession, where it really took a long time for those two to come back together. Again, that was kind of a U-shaped recovery. Took a long time to get the properties written down, took a long time to get them written back up. I think a lot of the improvement since then was more of a discipline by the investment managers to get the values right. A lot more data, certainly, to get the values right. And so that shape really looked a lot different during the more recent financial crisis than it did when you go back to the early 90s. It was still fairly wide, actually, during the tech bust that we had in the 2001 time period. So it'll be interesting to see what it turns out looking like this go around. I suspect and hope it's going to be more like and not that I want to have it end up being as many write-downs as we had during the financial crisis, but in terms of the shape, that things come back pretty quickly. And so, not surprising, an index of values dropped this quarter. So values down slightly. Again, first time since the financial crisis. This is an index of just what's happening to the value of the property by itself. And so the big question is, how far will market values drop before we return to the pre-COVID-19 level? We're down about 2% this quarter. I said there was a minus 1% return, but it was like a 2% drop in value, but offset by about a 1% income return, because we're still collecting rents on maybe not all properties, but we're still collecting rents on most properties. So we still had income. But is it going to be 0 to 10? Is it going to be 10 to 20, 20 to 30, which would be sort of what we saw with REITs, more than 30? I think when COVID started, there were some people that were in that 20 to 30 and more than 30 camp, but I'm not sure I'd be there right now. But we do have, wow, 30% of the people so far. Numbers still coming in. Nope, I was looking at that wrong. 53%, the majority by far, say it's going to be 10 to 20%. So that is further drops in values. And when we pulled the institutional investors, they did think there was going to be further drops. I think most think that we haven't really seen the full extent of the write-downs yet. We probably, going to have some for at least one more quarter. But we did have 27%. Let's see, let me read off the numbers. So 27% was 0 to 10% drop. 52%, as I said, were 10 to 20. 17%, 20 to 30% drop. 4% really concerned that there could be more than a 30% drop in value. That's pretty scary. I hope that one doesn't turn out.
It is interesting. A lot of things were impacted, Jeff, through the end of July, as you know, with the payroll protection and the unemployment extension benefit. A lot of rent was being paid above and beyond what it otherwise would have been, if not for those programs that then no longer exist. And the question will be, do they get extended, put back in place? And how does it get us to the other side of this crisis? Or are we left without a safety net in between here and a vaccine?
Yeah. Well, that would be a real disparity from what we're seeing in the stock market right now, wouldn't it? I mean, stocks back to hitting new highs, driven a lot by the large cap technology stocks, and some of that is understandable with the technology stocks because we're now working from home and we need working from home and we need that technology. Yeah. But I don't know. This is some more breakouts by property type, where we also have hotels in this case. So the quarterly returns by property type. I have to say that hotels is a very small sample. Institutional investors just don't have a lot of capital invested in hotels. But you do see about a 16.5% negative return quarterly for hotels. So hotels just really got killed this last quarter. Retail, so the return there was almost a -4, so that'd be like a -16% return on an annualized basis. Industrial actually managed a positive return. again, we all know what's going on, and that's mainly warehouse space with Amazon and everybody else getting into the online business. And then a slight negative for office and a slight negative for apartment. And this is just looking at a subset of data from the funds. ODCE is your larger open-end funds that tend to have more rigorous valuation practices. But I think the point here, except for hotel, which is again a small sample, the differences aren't that great in what we see for that subset of properties where there's presumably more rigorous valuations, more of a requirement to make sure the values are accurate every quarter. Rent changes. There we had negative rent growth even for the industrial. Hotel, wow, look at 50% change in rents. This is rents collected. It's not market rents, so it's rents actually collected. So down a little bit on apartments, down a lot on hotel, down a little bit on industrial, a little bit more on office, and down over 10% on retail. The big question on retail, though, is that rent that's never going to be collected, or is that rent we're still going to collect? It's just going to, start coming in, later this year or next year. So it's really hard to know how to interpret the negative rent growth for the retail properties. And I guess that would be true to some extent for the other property types, but I think it's retail where really you saw a lot of tenants just say, I'm not going to pay the rent this quarter. And then the NOI growth is pretty similar story. So difference here would just be we're subtracting out the expenses. So we dropped this quarter, again, negative for apartment. Apartment's not missing last quarter, which is right around zero. And then office is not missing this quarter. It's just right around zero for the NOI growth. But then the retail, wow, minus 30% in the change in net operating income this quarter versus last quarter. Couldn't do that for very long. I added this chart, just saw it recently on CMBS, commercial mortgage-backed security delinquency. I think this goes to a lower grade of properties on average than we've been looking at in some of the NCREIF data, but I guess I thought this was interesting in that it's really a pretty similar story. The most delinquencies for hotels, next most for retail. Overall average is about 8% in delinquencies, but then, just slight for office 3%, apartments 2%, and industrial property 1%. And I suspect those are industrial that aren't the warehouse properties that we normally see doing quite well right now. And then the rent change, we now have some charts where I broke it down by subtype. So you can see the biggest drop in rent was for the super regionals. We've seen a lot of loss of tenants in the in the malls, the regionals and super regionals. I think the neighborhood and this, well, let's stick with the neighborhood. I think that's probably one of the lower ones because those would tend to be anchored by the grocery store and the pharmacy, and you need those, and so they haven't suffered near as much as the super regionals and regionals. I guess it's a little surprising the community is as much as it is. And then if we look at apartments, you see the most drop in rents for the high rise, garden the least. I think that kind of makes sense in that maybe there's more concern in the higher rise, higher density apartments about the impacts of COVID-19. To a lesser extent on low rise, and then garden, you're not in that higher density situation. Jeff, if you have a better story, let me know.
No, I think that's you're exactly right. There's tremendous flight from the cities into suburban, so you're getting bidding wars on housing in suburban markets where the cities took all the people in the last cycle. Now they're coming back.
Yeah,
so
that takes us to the next chart, actually. So But I think what you're saying is the high rise tend to be in the CBD, right? And the garden will probably be more in the suburbs.
It's not just the garden, it's actually moving into residential single family and demand for single family homes with the low interest rates and the open space. So scarcity of product and a lot of demand.
Yeah. So you can see much greater drop in rents. This is just for the office subtypes. So we don't break out the other property types into CBD and suburban, but certainly a difference in the office rent change for CBD versus suburban. Occupancy, interestingly enough, hardly budged. I mean, we saw this big drop in rents, like for retail. We saw the big drop in rents, big drop in net operating income, but we don't see a drop in occupancy. And I think again, the story there is that we still have leases on those properties. The tenants are expected to pay rent. They just said, I'm not going to pay rent, this month and maybe next month until we start to have people coming back and we have customers, buying our products so we can pay our rent. So they haven't defaulted on their lease. Maybe technically they're in default, but as far as the owner is concerned, there's still a lease on that property. So what property sector do you think will perform best in 2020? The answer in the past has always been industrial. I'm not so sure that'll be true this time. I could see an argument for apartment or office. Not sure I see one for retail and hotel, but I could be surprised by some of the answers. Wow, 76.
Pretty narrow spread here.
Still coming in, but we have a few that we have 1% that voted for office so far. We have 1% for retail. Whoa, 1% for retail, and then ending up performing the best. You never know. Maybe
the recovery, play.
Yeah. Again, why in Simon Property Group is actually buying up some of the tenants, right? Maybe they know something we don't know. Why would you buy one of the tenants that's in bankruptcy if you didn't think you could do something with that tenant?
Again, there's a lot of retail, great locations, just need to figure out what to do with it. Does it become medical office? Does it become a distribution center? Residential? Lots of different things could be done with those locations potentially.
Right. Okay. And then the number of transactions, not surprising after all we've talked about, but wow, I mean, usually we've got a couple hundred properties that are being sold each quarter out of the index, but it dropped down to like 30 properties this quarter. We haven't seen that few properties transact since we go back to the financial crisis. A lot of things this quarter, we haven't seen since the financial crisis, but hopefully it's short-lived. And then I just added this because, of course, it's true globally. It's not just in the U.S. We've had a drop in the transaction activity. This comes from Real Capital Analytics, RCA, that collects data on every transaction over, I think, now down to $5 million in the U.S. And they also collect data on transactions on a global basis in a lot of different countries. So you can see here, they're down everywhere. COVID-19 is just everywhere, impacting all geographic areas. So I think this may be our final question. How long will it be until we can translate that into the market recovering, returns start increasing again? Is it going to be by the end of 2020? Based on what I've seen so far in your answers, maybe a few that are going to say we're going to be recovering by the end of this year. We're gonna get a virus, or it's just COVID-19 is just going to disappear, right? It seems like I've heard that said. It's just going to go away, or is it going to be the first half of 2021, second half of 2021, or 2022 or later?
Well, let's wrap it up. Got all of our polls in.
So it looks like most think second half of 2021, over 50%. Our mode is second half of 2021. So get ready for it.
It seems like that.
Yeah, so kind of a summary. And don't know if we had any questions that came in, but market values did turn
Maybe
negative.
while you're summarizing, we will remind everyone that we do have the question box open. We'll address the questions at the end. And I know one of the questions will be, will we be able to share the deck? Yes, and there'll be a recording out. So look for that first of the week. We'll get this circulated. So please come in with the questions. Jeff, you can wrap it up with the summary.
Yeah, maybe I should also give a pitch for RealNex, because I've helped to add a lot of the calculation capability to the program that we haven't had in the past. So you can use RealNex to analyze what your rate of return is going to be if you buy some of this property now while the prices are down. So market rents or market values did turn negative, and that caused the returns to turn negative for the first time since the financial crisis. Returns turned negative for all the property types except industrial, although we did see rents were down a little bit for industrial and net operating income was down a little bit. Transactions were the lowest level since the financial crisis, and that's of course why it's hard to put values on properties right now. Without transactions, it's hard for appraisers to really know where prices should be. You need those comparable sales. I mean, that's not the only approach to value properties, but it's a lot harder if you don't have any transactions and you just have to say, well, what's a reasonable rate of return in the current market, especially since we don't know what investors are willing to accept, and the cost approach is not very helpful when markets are not in equilibrium. So low level transactions, we had far more write downs than write ups. That haven't seen that since the financial crisis. And surprisingly though, cap rates were actually down slightly. But part of that I think is due to the fact that rents fell a lot more than values fell. But also we have declining interest rates and that nice spread between cap rates and treasuries. So it may be that we don't see much of a jump in cap rates. So it's really going to depend on what's going to happen to the amount of rents we can expect to get on properties going forward. That's my story, Jeff.
All right, and you're sticking to it. So let's just focus on that write down versus write up. One of the questions was the 80% write down. That would mean that if it was marked down by 1%, 10%, 20%, whatever, if it was at any degree written down then written up, there's going to be 100% are going to either be written down or written up.
That's right. So that's looking at it differently than looking at the value. So we saw that values didn't drop very much this quarter.
Right.
Values were only down 1%. Yet we had a lot of write downs. So I guess one way to say it is we had a lot of write downs, but they were little write downs. The amount they wrote down was not a lot. It's just that they wrote it down. So it's just a different way of looking at it. There may be some other ways we could evaluate that in some way, but I think the returns that we showed and everything else is really capturing the impact of how much values went down. So this is just a different way of looking at it. But it does make things maybe look worse than it really is.
Well, it just says, generally speaking, we hit a peak and prices are off that peak, and it's just it's order of magnitude from there, which is really the concern.
Good way to say it.
So there are a couple more questions have come in, and one is dealing with REITs. I don't know if you've got any perspective on it, but the question's about REITs selling assets to raise capital. Are you seeing any drive for REITs to sell? What are the motivators for them potentially to bring assets to market?
Yeah, I don't really follow the REIT sector. I just kind of looked at that for that one chart because I was seeing, and actually got called by a Wall Street Journal reporter asking me why there was such a difference between the private real estate market value changes and and REITs. But I don't know, and maybe it has been happening where REITs are selling their properties. Certainly some REITs are in trouble right now. Student housing REITs, you know, are definitely in trouble. The industrial REITs, I think, are doing pretty well. The Duke Realties, I think Simon Property Group, even though their stock price is down, they've got capital. I mean, David Simon, actually a former student, David Simon's been out buying, bankrupt tenants and working out deals with Amazon, and so that they clearly have capital. They don't have to sell properties.
And it seems like, as the relative to the stock market, the yields are high on REITs, which is causing those prices to go up. So it's just another way for people to get what they would perceive to be a safer yielding return. So that is different than the price of the asset and the investment in the asset. But the REITs don't seem to sell unless this type of environment, unless they have to, unless there's some pressure on. And I guess to that, there's other question: are you seeing any pressure from banks or insurance companies on the debt side to force foreclosures?
And not that I've heard of. And you made a good point. You said REITs don't tend to not sell, but that's really true of the institutional investors. The large investment managers, when the market is weak, they just don't sell because they figure the value of the property to them, the so-called investment value, is really more than the market value. And so and that's why we only saw 30 transactions. They're not going to sell when prices are down like they are now. They're just going to hold on to the properties.
I know you don't tend to.
I haven't heard of banks putting pressure on people. Have you, Jeff?
I've heard the banks are being fairly lenient, but insurance companies are being more aggressive in trying to take control of assets if they can. So it depends on the opportunity and the sophistication of the lender and what they can do. If they can, they think they can take advantage of the opportunity.
Yeah, that makes sense because the banks aren't really in a position to operate the properties, whereas the insurance companies a lot of times do have some of that expertise because they have real estate in their general account.
Right. So the question, you don't necessarily like to forecast but there's a question about that. What are you seeing in cap rates? You've dealt with it a few different ways in this conversation, but do you think they're, particularly in retail, going to hold steady or increase a bit in the next year?
Every time I do this webinar, and I've been doing it for a long time for NCREIF, I think cap rates can't go down anymore, but they just keep going down. And as we've talked about, there's capital out there. Interest rates in the U.S. are still higher than most other countries, and so there just doesn't seem to be pressure on cap rates going up. And if inflation starts to come back, that also tends to keep cap rates down, because we have to keep in mind that a cap rate is a result of what rate of return that you want on the properties, but that tends to be offset by growth that you expect to have in the income and the value of the properties. And so if we're expecting rents to start growing again and values to start going up, that tends to keep cap rates down. So I don't see a lot of pressure on cap rates going up. I have a hard time believing they're going to fall anymore.
And that spread is pretty wide. It's really staggering. You look at that 500 basis points versus 200 or so that it had been.
Right. So a lot of uncertainty right now about where they're headed.
I think we have time there's two more questions and we can wrap up. The question is on the relationship, cyclical relationship between commercial and residential. I don't know if you've got a perspective on that. I know I've got some history there, but have you done any research on the correlation?
I haven't looked at it recently. The last time I looked at it, they weren't highly correlated. And I saw it in the context of, you really ought to be investing in commercial real estate because it's not correlated with maybe the real estate you already own. If you own your house, right, you've got an investment in residential, right? and that doesn't necessarily mean you've got a good exposure to the real estate asset class, because commercial properties can behave quite differently. And certainly there's a rental properties and home ownership don't necessarily move together, right? They compete with each other to some extent. So they all tend to be impacted by the overall economy and GNP expectations, but
Yeah,
certainly
so that's what
can be
we've
some
seen
big
in the
difference.
past, and some of the research I've read anyway, that it's about an 18-month leading indicator, residential to commercial, and I think it's based on that economic activity that you talked about. So people, as they start to feel better or beginning to make purchasing decisions, and that's because the economy is doing better, which is leading to improvements in the commercial property.
I
But
know there's a lot of disparity around the country, but there's some areas where homes are selling right now in like in days
yep, and
from when
there's
they went
5
on the
bidders.
market, and here in Henderson, Nevada, next to Vegas, there must be 1,000 homes being built by all the major home builders right now. I don't understand where all the demand is coming from. And
This could be an outlier from historical correlation, but it's because it's just an unusual circumstance that we're dealing with. Finally, the question is, the commercial transactions you said are at the lowest level. I think it looked like, and the question is, what is the metric? It looked like we're about 80% off. I don't know if you want to bring that chart back or if you have it off the top of your head, but I'm pretty sure it was.
yeah, the number of transactions.
Yeah, it went
Yeah, so from reaching
300 to 30, something like that.
kind of a high of 250 down to 30. Yeah, so percentage wise, it's really quite staggering. So yeah,
So based on the zig and zag of this chart, hopefully we don't break that red line by much and start to pick up again next quarter. I think that is it for today. Jeff, we appreciate you as always. I really appreciate the work that you've done on the investment analysis. And as you mentioned, and for everyone to know, RealNex has a terrific, not only the investment analysis to model projects like this on the buy side and sell side to evaluate and help in the decision making of either listing price or on the decision to buy, but also on the comparative lease analysis as you're working with your clients to potentially renegotiate a lease if they need to extend, if they need some rent deferral, and then some pick it up on the back end to make sure that they're making a fair deal all along the way. The Market Edge product has a great tool to enable that. So take a look at that if you need
yeah.
it.
In fact, I helped one of our users to look at different alternatives for a lease renegotiation. So you can use our lease analysis module to analyze different alternatives for restructuring a lease. And I don't know if a lot of users of our Market Edge product realize that you can also use it to come up with what you think the investment value is for the property to you if you buy it. So a lot of different ways to use the program.
And I think you also put in the new accounting models for asset and liability entries on the balance sheet. So great stuff there. Want to thank everyone for joining us. Please consider coming back to us next week for the virtual reality session, and certainly we'll be notifying you with the replay of this session and our next quarterly pricing trend when Jeff has his latest data in for the I guess it'll be the third quarter then. So Jeff, thank you again. Thanks everyone for attending. Hope you all have a great afternoon and good weekend to come.